Welcome back to the SOT System channel, where we break down digital trends, capital shifts, and the strategies behind long-term wealth building. This week marked a critical moment for digital assets in the United States. The U.S. Senate officially postponed scheduled committee markups for what is known as the Clarity Act, the Digital Asset Market Clarity Act of 2025. On the surface, it looks like another political delay, but in reality, this bill represents the most comprehensive attempt in U.S. history to define how digital assets, crypto markets, and decentralized systems will operate. And its delay tells us a lot about where power, money, and technology are colliding. Today, we're breaking down what happened, why it matters, how markets are responding, and how long-term investors can think about positioning during moments like this. First, let's clarify what the Clarity Act is and what it is not. The Clarity Act is not a stablecoin bill, which became law in July of 2025. That law focused narrowly on payment stablecoins, requiring full reserve backing and banking-level oversight. The Clarity Act is different. It targets everything else in the digital asset economy: Bitcoin, public blockchain tokens, crypto exchanges, tokenized assets, decentralized finance, and digital commodities. Its purpose is to end regulation by enforcement and replace it with an actual legal framework that allows this industry to operate at institutional scale. So, what does the bill actually do? Splitting oversight between the CFTC and the SEC, it aims to place mature networks like Bitcoin under CFTC spot market authority, create national standards for exchanges and brokers, protect customer assets, clarify the treatment of decentralized protocols. In simple terms, this bill is meant to build the legal foundation for the next generation of U.S. financial markets. It's a massive undertaking. Here's what happened in the Senate. On January 5th, 10th, and 16th, Senate committees had scheduled executive sessions to debate amendments and advance the bill. Those sessions were officially marked postponed, with no immediate replacement date announced. At the same time, the Senate Agriculture Committee, which oversees the CFTC, delayed its related hearings. This was not a simple scheduling conflict. It was a political stall. Leadership reportedly did not yet have the bipartisan support needed to safely move the bill forward without it being torn apart by last-minute amendments. Why was it delayed? Several powerful forces collided at once. Internal divisions remain unresolved over how decentralized systems should be regulated and how authority should be split between agencies. At the same time, major crypto firms push back hard. Coinbase's CEO publicly withdrew support, calling the draft worse than no bill. He cited major concerns over yield restrictions, limits on tokenized markets, DeFi oversight, privacy risks, and a weakening of CFTC authority. While this was happening, traditional financial institutions intensified their lobbying around provisions that could compete with bank deposits and accelerate tokenization outside their traditional custody systems. The result was a pause, not to kill the bill, but to force a renegotiation. Despite the headlines you might be seeing, the Clarity Act is not dead. Support remains bipartisan in principle. Negotiations are continuing behind the scenes. New draft language is expected, and late January or early February markups remain possible. The delay reflects complexity, not collapse. Think about it. Digital assets now intersect banking, securities, commodities, payments, and monetary policy. That level of disruption does not move quietly through legislation. It's a fight for the future of finance. How did the market react? Markets definitely reacted, but they did not break. Bitcoin briefly softened as regulatory uncertainty resurfaced. Some altcoins and crypto-exposed equities pulled back a bit. Sentiment definitely weakened, but structurally, nothing broke. ETF inflows continued, liquidity trends remained intact, and Bitcoin held its higher range support. This is where the opportunity lies. Political delays create uncertainty. Uncertainty creates volatility, and volatility creates opportunity. This is where long-term wealth is built. At SAT System, we consistently teach a strategy called TDCA, or triple DCA. that stands for Double Down Dollar Cost Averaging. TDCA is a volatility-enhanced accumulation strategy designed specifically for long-term investors. Here's how it works. You invest a fixed amount on a regular schedule into quality assets. That's your base dollar cost averaging layer, which you're probably already familiar with. But here's the key. When markets experience a meaningful pullback, typically 10 to 15% from a recent high, TDCA activates. Instead of panicking, you double or even triple your next scheduled investment. TDCA is not about trying to time the absolute bottom. It is about systematically overweighting volatility and buying more when assets are on sale. Events like the Clarity Act delay are perfect examples of why TDCA works. They often create short-term inefficiencies and fear. You're turning market anxiety into your advantage. Looking at the long-term implications, if the Clarity Act is eventually refined and passed, it could unlock major institutional capital flows. We're talking about regulated crypto exchanges at a global scale, tokenized equity and bond markets, legal certainty for builders, and a whole new phase of U.S. digital financial infrastructure. On the other hand, if the delays stretch on for too long, innovation and capital will continue migrating offshore to friendlier jurisdictions. Either way, the direction is set. Digital assets are being negotiated into the global financial system. This entire situation exposes a deeper truth. Crypto is no longer just a speculative side market. It now directly challenges traditional banking models, securities frameworks, payment rails, capital markets, and even monetary power. That is precisely why comprehensive legislation is so inherently slow and difficult. The Clarity Act is a struggle because it is foundational. It's a battle over the rulebook for the next century of finance. So, for you as an investor, here's the conclusion. The Clarity Act delay is not a rejection of crypto. It is a confirmation of its importance. Markets may wobble. Headlines will rotate between good and bad. But the structural forces driving this revolution remain unchanged. The rise of digital money, the tokenization of everything, the institutional pipelines being built, the global liquidity cycles, and worldwide monetary competition. For disciplined investors, this environment favors strategy over speculation. Volatility becomes your tool for positioning, not a reason to panic. If you want to understand how these powerful digital trends translate into real investment positioning, subscribe to the SATM channel. And visit SAATsystem.com, where we provide market analysis, on-chain insights, and set tools designed to support disciplined long-term investing. Digital trends are reshaping money. The question is not if, it's whether your capital is aligned before the clarity finally arrives. Thanks for watching.